When a stock breaks out of a falling trend with, just sudden massive delivery numbers, is it flashing a strong buy signal, or is it just another trap where retail traders are going to get crushed?
Yeah. Well, the data we're looking at today is, honestly, it's practically schizophrenic. I mean, it's
Yeah.
pointing in two very extreme directions at the exact same time, which is creating one of the most volatile setups on the board right now.
Yeah, and before we unpack this, make sure to like the video, subscribe to our YouTube channel, and it's compulsory that you leave us your feedback in the comments. We really want to know where you stand on this setup.
Right. And just a firm reminder before we get into the weeds here, this deep dive is strictly an analysis of the provided data. We're just having a natural human debate about the numbers, the underlying mechanics, and the market psychology. This is absolutely not financial advice.
Exactly.
We are evaluating the landscape, right? Not telling you what to do with your portfolio.
Yeah, keep that in mind, always. So the mission for today, it is April 14, 2026. We are looking at NIO Inc., ticker symbol NIO. Currently, the stock is trading at $6.56, which is up about 0.92% intraday.
Right.
And we're going to dig into its financials, the technicals, and just this incredibly fierce bull versus bear debate surrounding it. Because to understand what's happening with NIO today, you really have to look at the sheer scale of the tug-of-war happening on the charts.
Yeah, you do.
Let's start with the baseline numbers.
Yeah.
The 52-week range is a low of $3.34 and a high of $8.02. So at 656 today, we are, sitting much closer to the top of that range.
Which is a massive recovery. And that recovery, it tells a story of really aggressive accumulation. If you track the order flow, like monitoring where the institutional block trades are actually landing,
Right.
you see a very clear, heavily defended battleground. So right now, there is significant algorithmic and institutional buying happening near the $6.07 support level.
Okay, so 607.
Right. The big players are treating that specific price point as a fundamental floor. But, and this is the moment the stock creeps up into that $7.42 to $7.90 zone, it just hits a brick wall of selling pressure.
Okay, let's unpack this. Because we see accumulation at, around $6 and massive selling around 780. So I got to ask, are we really seeing a bullish setup?
Well,
Or is this like a crowded room where the buyers are waiting at the basement door, but the sellers are completely blocking the stairs to the roof? Like, is the stock just stuck, or is it actually building pressure for a breakout?
I'd say the broader trend suggests the pressure is compounding toward a breakout. I mean, NIO recently broke out of a multi-month falling channel, and that wasn't just a minor blip.
Yeah.
That was a structural shift in the asset's trajectory. And if you look at the short-term indicators, they're aggressively signaling a momentum shift.
Yeah, the moving averages.
Exactly. The stock is currently trading above both its 50-day simple moving average at 534 and its 200-day moving average at 553.
Which are strong buy signals. And we're also seeing that classic inverse head and shoulders pattern on the chart. Right?
Yes. What's fascinating here is that right shoulder.
Right. It just successfully bounced off the $5.20 floor, which tells us the sellers have completely run out of ammunition after that really deep head drop back in March. I mean, the bears threw their absolute worst at it. They couldn't break the floor, and now the buyers have essentially seized the steering wheel.
And that exhaustion of selling pressure, it's entirely backed up by the momentum oscillators, the Massey-D, the moving average convergence, divergence. It just triggered a positive crossover at 0.252.
Right.
So for those tracking the mechanics, this means the algorithmic momentum traders are waking up. The short-term trend has officially crossed above the long-term drag.
Okay, so you're pointing to the momentum shifting, but what about the RSI? Because the 14-day relative strength index is sitting right between 59.06 and 62.89.
Right around 60.
Yeah, and you're looking at a 60 RSI as a bullish signal. But in a market this volatile, doesn't that just mean it's sort of lukewarm? Why should anyone trust a mid-range technical indicator when the fundamental environment is just this chaotic?
Well, because a 60 RSI is actually the definition of a healthy climb. It proves buyers are confident right now, but crucially, it is not yet overbought.
Ah, okay.
If we were looking at an RSI over 70, then yeah, you'd expect an immediate violent pullback because the asset would just be running too hot.
That makes sense.
At 60, institutional buyers still have plenty of runway to accumulate before they trigger any overbought alarms. But we still have to respect the technical boundaries here.
Which are?
Immediate support is anchored at 607 with a disaster scenario strong floor at 520. And immediate resistance is staring us down at 663 with the major ceiling at 790.
Okay, so that RSI sweet spot proves buyers are confident. But to understand if that confidence is, actually justified, or if they're basically walking blindfolded into a trap, we have to look at what's actually funding this momentum.
We do. We have to look under the hood.
Exactly. Because NIO's balance sheet tells a much darker story. Let's start with the income statement from the full year of 2025, which honestly is staggering.
The growth is wild.
It is. Total revenue hit 87.49 billion RMB. That is a 33.1% year-over-year increase. I mean, they are moving metal at an unprecedented rate.
Yeah, the operational scaling is undeniable at this point.
And it's not just like top-line vanity metrics either. Gross profit soared by 83.5% to 11.92 billion RMB. Their net loss narrowed by a third, dropping down to 14.94 billion RMB.
Which is huge.
Yeah, and even more impressively, their vehicle margins, like the actual profit they retain on the physical cars they sell, improved from 12.3% to 14.6%. They basically transitioned from a high cash burn startup wildly throwing money at growth to a disciplined, margin-focused manufacturer.
Right.
And the crown jewel of all this, late 2025, they achieved their first ever quarterly GAAP profit of $40.4 million.
Yeah. And hitting that GAAP profit is a monumental milestone for literally any EV manufacturer.
But here
it comes. We have to pivot to the balance sheet because that is where the bullish narrative hits a massive roadblock.
Yeah. Let's talk about the liquidity scare.
Exactly. Yes, they reached a turning point with positive operating cash flow in Q3 and Q4 of 2025. And yes, they have a seemingly stable liquid cash reserve of 45.9 billion RMB, which is roughly 6.6 billion US dollars.
Okay, that sounds like a lot of cash.
It does, but their liquidity profile is structurally compromised.
Okay, define compromised. Like, what are the actual liabilities we're talking about here?
So as of December 2025, NIO's current liabilities stand at 78.58 billion RMB. Meanwhile, their current assets are only 76.63 billion RMB.
Wait. So their short-term debts literally exceed their short-term assets?
Yes. By nearly 2 billion RMB, they are operating with negative working capital.
Wow.
And in the world of corporate finance, a structural risk of this magnitude, it triggers auditors to issue a going concern assessment.
Yeah, and for you, the listener, a going concern warning isn't just like a minor red flag on a spreadsheet. It is the auditors officially questioning whether the company has the financial resources to avoid bankruptcy and keep the lights on for the next 12 months.
Exactly. It's a very serious label.
Right. Now, management claims their available credit lines, mixed with that recent Q4 profitability, gives them a safety net to weather the storm. But I have to ask, is NIO essentially trying to execute a massive debt swap mid-highway while accelerating? Like, is this like someone finally getting a massive promotion at work, but they are still completely drowning in high-interest credit card debt?
That is a brilliant way to visualize it, actually, because earning that GAAP profit and boosting revenue 33%, it proves the engine works. Right, the car can drive.
But the current liabilities, that short-term debt, is the toll booth approaching at 100 miles an hour. If anything disrupts their cash flow, say a sudden supply chain shock, a dip in consumer demand, or credit markets freezing up so they literally can't roll that debt over,
the
situation becomes precarious practically overnight. Man, that's tense.
Yeah.
And because of this jarring disconnect, the soaring 87 billion RMB revenue on one hand, and a negative working capital balance sheet, triggering going concern fears on the other. How is Wall Street attempting to price this? Because trying to value this stock feels like trying to appraise a burning rocket ship.
Well, the institutional consensus is fractured, to say the least, though it does lean slightly optimistic. Roughly 60% of analysts rated a buy, 30% a hold, and only 10% issue a sell rating.
Okay.
The average price target is $6.76.
Which is only 20 cents above where it's trading today. I mean, that's barely a bump.
True, but look at the spread behind that average. You have UBS issuing an aggressive high target of $8.50, betting entirely on the growth trajectory.
Right.
Then you have Barclays dropping a brutal low target of $4 flat, focusing strictly on the margin compression and the debt. I mean, half of Wall Street sees a coiled spring, the other half sees a ticking time bomb. And this divide centers entirely on one specific metric.
Yeah.
The forward price-to-sales ratio.
Yeah, the PS ratio. So right now, NIO trades at a forward PS of 0.74.
Right.
For context, that means investors are paying just 74 cents for every dollar of sales NIO is projected to make over the next year. Compared to its direct rivals, like Li Auto and XPeng, NIO looks ridiculously cheap. Based purely on the volume of revenue it generates, it looks like a deep value bargain.
And that right there is precisely where retail traders step into the bear trap.
Yeah, because they see the surface numbers.
Exactly. I want to warn you about this. You pull up a stock screener, you see a $6.56 share price, you see 33% revenue growth, and you see a 0.74 price-to-sales ratio.
That's great.
It looks like the market has mispriced a giant, but screeners don't provide context. A PS ratio under 1.0 in a high-growth sector exists for a reason.
Right. The market isn't stupid. The market is heavily discounting the stock because of that negative working capital we just talked about.
Yes. The market isn't just discounting it. It is pricing in a massive risk premium for the sheer volatility of their financial position. The trap is buying in based on top-line revenue growth without understanding the structural threat to the bottom line.
Right.
If interest rates remain elevated and rolling over that 78 billion RMB in short-term liability becomes excessively expensive, well, that quote-unquote cheap valuation will not stop the stock from cratering to $4.
But let's bring in a different perspective here, one that completely reframes that valuation debate. Because if we look at that PS of 0.74, are we strictly valuing a traditional car company, or are we fundamentally mispricing an infrastructure monopoly?
Ah, the battery swap argument.
Exactly. Because NIO's ultimate moat isn't just the cars, right? It's their battery swap network.
Yeah.
They have over 3,800 of these physical stations operational.
Which completely changes the mathematics of their balance sheet. Because building 3,800 physical infrastructure stations requires a colossal amount of upfront capital expenditure. That CapEx is a massive driver behind the negative working capital we just discussed. They are bleeding cash to build a moat.
And think about the consumer appeal. I mean, while drivers of competing EVs are sitting at charging stations for, 40 minutes waiting for a plug-in charge?
At least.
Yeah. An NIO driver pulls into a swap station, an automated system drops out the depleted battery, bolts in a fully charged one, they drive away in under 3 minutes. Nobody else has this scale of infrastructure.
No one. And if battery swapping becomes the mandated or even just the preferred industry standard in China or globally, NIO doesn't just sell cars anymore. They become the primary energy provider for a massive segment of the transportation grid.
Which brings us to the ultimate bull versus bear debate. I'll take the bull case here, because the catalysts aligning right now are just massive.
All right, lay it out.
We already covered the Q4 2025 profit validating the model. But look at what just happened in Q1 2026.
Yeah.
A 98% surge in quarterly deliveries.
Yeah.
They pushed over 83,000 units in just 3 months.
And scaling to 83,000 units in a single quarter requires flawless supply chain execution. I mean, that's not easy.
No, it's not. And they are expanding their demographic entirely. They're launching the highly anticipated ES9 SUV for the luxury segment. But the real needle mover is the rollout of the ONVO sub-brand.
Right, the mass market play.
Exactly. They are taking direct aim at the 200,000 RMB segment, which is that mass market middle-class sweet spot. Analysts project the ONVO launch alone could drive 40 to 50% growth through 2026. They're no longer just a niche luxury player. They are going after Tesla's Model Y market share with a cheaper, faster charging alternative.
Okay, the volume projections are impressive, I'll give you that. But if I take the bear case, I have to look at the brutal macroeconomic reality waiting for that ONVO brand.
Which is pretty harsh.
It is. NIO does not exist in a vacuum. They are fighting for survival in the single most aggressive cutthroat automotive market on Earth, which is China.
The price.
The relentless price wars. You have absolute juggernauts like BYD and Tesla aggressively and repeatedly slashing prices to maintain their market dominance. They're willing to bleed their own margins just to crush smaller competitors.
Yeah, and when Tesla cuts the price of a Model Y, NIO is forced to cut the price of the O and VO, or they simply won't sell any cars.
Exactly. Which means that hard-won 14.6% vehicle margin we celebrated earlier, it gets compressed, it evaporates. The bears argue that NIO's path to consistent, reliable profitability is structurally blocked by competitors who have infinitely deeper pockets and can just afford to operate at a loss longer than NIO can stay solvent.
Especially considering NIO's negative working capital. I mean, they don't have the cash buffer to survive a multi-year price war.
Exactly. And factor in the global macro environment as well. We're seeing intense trade tensions regarding Chinese EV tariffs in Europe and North America.
Right.
You have fluctuating inflation and high oil prices dampening the global consumer's appetite for cyclical, big-ticket purchases. I mean, buying a new EV is a massive financial commitment. Oh, yeah?
If the global middle class feels the economic pinch, high growth, high debt auto stocks are the very first assets to suffer liquidations.
Okay, so the timeline here is super critical. Short term, the consensus is undeniable. Momentum is highly positive. The market algorithms are digesting that massive Q1 delivery beat of 83,000 units. The MACD crossover is validating the breakout, and the stock is riding the technical wave up from its lows.
Right. The short-term view is entirely dominated by that delivery momentum and the technical chart breakouts.
Right.
But the medium to long-term outlook looking toward the end of 2026 and into 2027, that is where the existential test lies.
Yeah.
NIO's internal projections call for 50% revenue growth this year and another 19% in 2027. Their entire survival strategy hinges on achieving a full-year operating profit by late 2026.
Because if they hit that full-year profit, the debt becomes manageable and the auditor's going concern fears evaporate entirely. Right. They simply have to outrun the price wars and meticulously manage their short-term liabilities long enough to reach that oasis. It leaves investors with a profound layer of uncertainty. I mean, if you isolate your view to the technicals, the RSI, the moving averages, the volume accumulate, the signals scream, buy. But if you open the hood and audit the balance sheet, the liquidity strain whispers a heavy, heavy warning of caution.
It really is the ultimate showdown between algorithmic chart momentum and fundamental accounting reality. But here's where it gets really interesting, and here's the thought I want to leave you to mull over. We touched on those 3,800 battery swap stations earlier.
Yeah.
The market is currently valuing NIO as a highly leveraged car company fighting a price war. What happens if traditional plug-in charging hits a technological or grid capacity wall?
Right.
If 3-minute battery swapping becomes the necessary infrastructure of the future, does NIO's massive capital-intensive physical network suddenly become far more valuable than the vehicles they're actually manufacturing?
I mean, if they successfully establish a monopoly on the infrastructure of the future, the traditional valuation metrics we're using today become completely obsolete.
Something to think about while you watch the charts this week. Keep your eyes locked on that $6.07 support floor and that critical $7.90 resistance ceiling. We'll be watching right there with you.